Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is September 8th and this is a weekly markets update. Let's have a look at the news of week 36 and see what are the next trends. Next week, I will be very glad to meet all my friends and colleagues in the conference of Hem Courier in Lviv. So join the conference and learn everything about new developments in the Ukrainian market and prospects for the next season. Indian urea purchase tender volume hit the record last week, but price was lower versus general expectation and my personal expectation as well. The tender is not finalized yet. We will know final result this week, but it is already clear that Indian government is targeting to maximize its purchase. Total offered volume was over 5.6 million tons, almost equal to both costs. Acceptances exceeded 3.8 million tons on Friday, the latest info available. This is almost twice more than initial NFL target of 2 million tons. Taking into account that shipping window is until October 22, unlikely that such volume will be available, so perhaps NFL will stick to more or less its target. But anyways, in this case, some, if not many suppliers will be disappointed, and it will add to the bearish sentiment. The interesting question is the price. There were many speculations before the tender if sellers would like to keep the general tender price level high in order to minimize market downward price correction for September-October. But it didn't happen, and price dropped by almost $70 versus the previous tender. L1 to the west coast this time was almost $465, to the east coast $462.5. My personal stake was around $475 to $80, so a large gap. So bearish market sentiment will persist and global price for Q3 will continue slipping. Supply for the tender will be dominated by Middle East and Russian product, for prills at least. The netbacks will be around $440 FOB for Middle East and around $400 FOB for Baltics. Northern African producers will focus on other regions as the netback is too low for them. Chinese tone participation is still the main question for the market. Some sources expect 300,000 to 400,000 tons to be supplied from China. There is no official info, but in any case, it will not be the dominating share, as China goes on holidays during first week of October, and then export window closes. Spot activity was very slim during the week because everyone was watching the tender unfolding. Prices across the globe corrected downwards immediately as first information about tender price level was revealed. European demand is absent, so there were no fresh deals from Northern African producers emerging last week. Nominal price of Egyptian product dropped to around $460 to $70 FOB level. Nigeria and Dangote closed a sales tender for 3 lots of 30,000 tons each for September shipment, but seems like the sales didn't happen. The price level also reflected the netback to India, as elsewhere demand was non-existent. Ethiopian ABC announced urea and phosphate tender for supply through 25-26 season. Tender will close on September 16. Tender details with shipment schedule are expected this week. Urea volume announced was almost 500,000 tons, so let's see if this time ABC confirms any significant amount. In the Black Sea, situation with demand was similar, and now the question is if producers send any volumes to the Indian tender. If so, the netback would be around $410 FOB or slightly higher. Iranian producers are in a difficult situation because port stocks seem to really press them, and price targets are constantly higher than the market, that is quickly correcting downwards. Last week, target of $405 FOB was already completely outdated, and sales tenders last week haven't finalized with any sales. Stocks are evaluated close to 1 million ton, and producers will need to take bold decisions very soon. Brazilian demand was still absent and prices were slipping during the week until reached $440 CFR after Indian tender price opening. This level is closer to the affordable barter ratio, but not there yet, so buyers are watching the market and waiting. In the US, trading activity was also very low. Prices dropped to low $410 FOB level per short ton. Buyers still need product to bring before river closure, which will happen in the first decade of October. But there is some more time left to see the tender aftermath and take purchasing decisions. Company-related news emerged from Ukraine, where government announced privatization tender for Odessa port plant, 1 million tons prilled urea and ammonia producer, that stayed idle for about 4 years now. This is a long-lasting story, and it is not the first tender that was announced, but without success. There are financial reasons behind, as well as poor technical state of the plant, which is not even related to the war in Ukraine. However, plant is strategically located in the Black Sea port with significant amount of land on the pier and close to the pier, has significant storages for ammonia transshipment and also bulk goods, of course. So on the opportunities side, there are plenty of options for development, including possibility of building, for example, LNG terminal, which will be extremely important asset for the country after the war ends. But issues that I mentioned, and respectively the potential price of this deal, was always a deal breaker, weighing on the investor sentiment regarding such deal. And I'm not even touching security-related risks. So I will watch the situation very closely, of course, because if the tender is successful, it will be a huge change for my country, but also for the whole region. And I will keep you updated as well. Paper values reflect a general bearish sentiment in the market. Egypt FOB decreased by $5 more for both September and October. The same was observed for Brazil CFR benchmark. Arab Gulf FOB values remained unchanged, as their tons will be the key for supply to the record Indian tender. Non-FOB also hovered almost at the similar level versus a week ago. Ammonium sulfate prices softened last week amid very slow demand and ample supply from China. Chinese FOB copper price decreased to $145 to $55 range, and granular slid to $160 to $67. Brazilian buyers purchased around 30,000 tons of Chinese compacted product, around $175 CFR. But there is a lot of product available, some of it floating, which is of course weighing on the price level. Elsewhere, the demand was mostly subdued. Nitrates market again was quiet. In Europe and Ireland, everyone is just waiting for new prices from Yara and other producers. The expectation is there should be a downward correction, of course, seeing as how urea has softened so much. Once urea finds a floor, producers will form their pricing strategy. Before that, buyers are reluctant to take fresh positions in the hope that nitrate markets prices will be lowered soon. In the ammonia market, prices continue to be supported by supply constraints both sides of Suez. East of Suez, news about extended turnaround at Ma'aden plant provoked price increase by $10 to the level $320 to $40 FOB Middle East. Some market sources say that downtime might be as long as 6 months, but these are rather rumors. Anyway, this supply disruption will significantly influence price to India, which have already reacted. The increase is not that dramatic yet due to Iranian product inflow. West of Suez, in the northern Africa, Sorfert sold a spot cargo of 15,000 tons at $535 FOB, which is more than $10 increase from the latest sales. Spot supply from the region is limited for September, so price increase is logical. Further west, in the US, supply is still tight, and still there are no news about potential gas curtailment in Trinidad. Domestic demand from downstream fertilizers producers is robust, tightening market balance for September and pushing prices up. Agricultural demand further in autumn will add to this. On the other hand, export supply is healthy, with prices stable for now, but last week Tampa price surge might influence also the FOB level. There is no sign of Gulf Coast ammonia plant coming back to production anytime soon. In phosphate segment, the sentiment remained rather bearish, with Indian demand cooling down and buyers elsewhere resisting high price level. However, appetite from Bangladesh and Ethiopia supported the market, and prices haven't slipped significantly. In Bangladesh, the Minister of Agriculture has issued a new purchase tender, closing on September 16, for 165,000 tons of DAP, 110,000 tons of TSP, and 20,000 tons of MAP. Shipment has been requested by the end of October. It is unclear for now if this volume is a separate tender or it will be added on previous July tender when Bangladesh Ministry of Agriculture confirmed purchase of only half of its initial 500,000 tons target for DAP. Supply of Chinese volumes to the July tender is still a question mark, as well as participation in the fresh tender. However, most likely an additional export quota that is expected before October might be massively diverted to Bangladesh. Ethiopian ABC also issued a purchase tender closing the same date, September 16, for 549,000 tons of DAP to be supplied during 25-26 season. Pivoting from imports of NPS to DAP in the past year was one of the most important bullish factors in the global market. This fresh tender is understood to be the first one in the wave of tenders for the next season. At the same time, Indian spot demand is decreasing due to ample import supply of last weeks and also finalization of the purchasing season. Thus, CFR price continued its slight but steady downward correction to the level of $806 on the low end now, formed by the sales of 30,000 tons of Russian product for end September shipment. Other than that, there was no spot activity. Only contract volumes from OCP and Ma'aden continued inflowing. After significant purchasing activity, Indian government succeeded in increasing of DAP stocks to the safe level. However, still low versus previous years. It indicates that during off-season, India will likely continue purchasing, perhaps, in order to bring stock level to the averages of previous years. After the big meeting in China last week, there is still no clarity if terms of its effect at concrete economic questions and fertilizers industry specifically. The market hasn't received clear sign that Chinese product can go directly to India. Let's see how it evolves further. Fresh export sales were lacking last week, but floor price for DAP was increased to $780 FOB China. Bearish market sentiment was also supported by weaker results of Egyptian NCIC sales tender that was closed on August 28. DAP price dropped by $10 versus July to $795 to $800 FOB. TSP price dropped even more by $20 and SSP price also by $10. Brazilian demand remains subdued and prices unchanged. Ports' warehouses are still overloaded with previous imports, and high prices freak out domestic buyers. The only market where price increased last week was Europe. After July 1st, when additional duties were imposed at Russian products, phosphate supply sources became quite limited. And in front of the active purchasing season, prices increase. Russian producers at the moment have better netbacks to other markets. Thus, OCP sold a small lot of DAP last week at higher price of $835 to $50 CFR. There was no trading activity in the US NOLA last week. Moving to the fundamentals. European natural gas prices were steady, around 32 euros per megawatt hour. The latest data showed that gas storage in the EU is over 78% full, maintaining the pace for the objective of hitting 80% by the start of November. The comfortable availability matched surveys indicating that LNG imports were over 50% higher since the start of the year, consolidating Europe's security of sources. Concurrently, exports of LNG from the US rose to an all-time high in August as key plants finished maintenance programs. US natural gas futures inched lower to $305 per MMBTU on Friday, tracking the pullback in energy, commodities, and as pessimistic labor market data in the US limited the outlook on demand. Despite the pullback in the session, evidence of robust global consumption underpinned prices above averages from August. Exports of LNG out of US ports rose to a record high amid stronger demand from Europe and added capacity in LNG plants. In the meantime, the Energy Information Administration noted that the US will reach a new peak in 2025, totaling 91.4 billion cubic feet per day. Agricultural commodities future prices moved differently last week. Wheat futures slipped again below $5 per bushel, amid abundant global supplies and softening demand. A large Russian export is set to boost shipments from the Black Sea region, while Australia's upcoming harvest is increasingly expected to be well above average. In the EU, Germany's agriculture ministry projects winter wheat output to rise by 26% this year. Recent rains have also improved prospects for Northern Hemisphere wheat planting after some drought conditions. Corn prices climbed more toward $4 per bushel, driven mainly by strong international demand. Global shipments from the US since January have reached nearly 45 million tons, up by 47% from the previous year, cementing corn as the top US export crop in 2025. On the supply side, the spread of diseases, tar spot and southern rust in US fields has curbed effective output, adding to upward pressure on prices. This was also supported by drought conditions worsening across some states in the Midwest. Meanwhile, Black Sea producers started to harvest corn last week, and this year's harvest is pushing last year's volumes out of the market. Soybean futures extended losses toward $10 per bushel as concerns over weak demand and rising competition from top producer Brazil weighed on the market. A lack of new US soybean purchases by China amid ongoing trade tensions with Washington continued to pressure the oilseed market. Meanwhile, Brazil's soybean planted area for the 25-26 season is expected to expand by 1.5% to a record, as the country increasingly supplies China while Beijing avoids US oilseeds. China is also actively purchasing Argentinian product. From July until now, China purchased more than 8 million tons already. Thus, experts predict that China can easily avoid purchasing from US until the end of the year at least. Moving to the shipping industry. Containerized freight index hovered at the level similar to last week. But finally, some changes are happening in the market. Index stability is the result of opposing trends in different trade lanes. While a significant increase in trans-Pacific rates pushed the index up, a major drop in Asia-Europe rates counterbalanced this surge. After 11 consecutive weeks of decline, spot rates from Shanghai to Los Angeles increased by 8%, while those from Shanghai to New York jumped 12%. Despite the upcoming Golden Week holiday in China, it is unlikely that these rates will be sustainable, though. Asia-Europe spot rates slid by 7 to 10%, depending on the route, due to continuously growing surplus of vessel capacity. The Baltic Exchange Dry Index slightly corrected downwards last week. The Capesize market experienced a shift in sentiment over the week, starting on a subdued note before softening midweek, before gradually improving across both basins with renewed support towards the close of the week. In the Panamax segment, the week also began on a subdued note, but saw a marked shift midweek as fundamentals improved significantly. Once again, the Atlantic basin was the primary driver of momentum. In the Pacific, the market gained steadily throughout the week, buoyed by the positive tone emanating from the Atlantic. For Ultra-Supramax segment, it was somewhat of a protracted week, as poor sentiment in Asia saw a slight slowdown in the region. The Atlantic overall was positional, with US Gulf demand fluctuating, and the Asian arena was relatively subdued. In the Handysize segment, market remained steady and relatively balanced throughout the week. The continent and Mediterranean regions experienced modest upward movement. Meanwhile, the US Gulf showed some signs of softening. To sum up, first results of Indian tender turned out to be very bearish for the market. The volume offered is record high, and most likely Indian government will leave out of its purchase now quite significant volumes. The price is almost $70 less versus previous tender, thus all global benchmarks immediately corrected downwards, reflecting Indian netback, in the absence of other demand, of course. Chinese participation is still questionable, but even without massive supply from China, the sentiment already turned to bearish. Market needs to find robust demand from other regions to support slipping price level, which seems now unlikely. Ammonium sulfate price dropped due to sluggish demand from Brazil, which also is caused by ports overstock. Ammonia price climbed more on the news that mountain outage might be more serious, and turnaround might take longer than market initially expected, maybe as long as 6 months. Price trend in phosphates was also declining, but just slightly, not like in nitrogen segment. Large tenders announced by Bangladesh and Ethiopia supported the sentiment, while demand in India is slowly decreasing and other markets' demand hasn't surfaced yet. Natural gas price in Europe was stable, while price in the US dropped a bit amid very healthy production figures. Future price for corn climbed more amid strong exports and fears about potential harvest losses due to diseases in the US, while wheat and soybean prices slipped more on the basis of healthy output and weak global demand. Container shipping rates stabilized, and bulk shipping activity slowed down a bit due to unstable demand patterns across geographies and segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.